Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. We've got two guests for you today from Missional Capital Group. It's Troy Zimmerman and Nate Shields. Missional Capital Group creates real impact by passively investing in real estate. They are a real estate investment company that focuses on acquiring and managing commercial, multifamily, and retail assets for like-minded investors. Let's get to the guys. This is episode 224 of Zen and the Art of Real Estate Investing with my guests. Everybody knows I like it when there's two guests with me, Troy Zimmerman and Nate Shields. They are part of the team at Missional Capital Group. Missional Capital Group believes that financial success should be driven by purpose and ethical principles. Their journey began with a simple yet powerful vision to create a platform that aligns financial prosperity with social responsibility. I love it. Guys, welcome to the show.
Thanks, Jonathan.
Thank you. Thank you for having us.
Yeah, no, I've been connected with you both on LinkedIn for a while, so it's good to connect in person in this way that we all do now. Let's just get in quickly to each of your backgrounds, and then we'll take it from there. Troy, first for you, when was the first time you remember being interested in real estate?
I've actually been investing or involved with real estate for about 20 years. I was fortunate. I grew up in a family who had a local business in St. Charles, Illinois, the town I grew up in.
Yeah.
My grandfather and father ran a car dealership. And they were fortunate to have some good years, especially back in the 80s and 90s.
Yeah.
So they would take some of their profits and they would buy triple net commercial assets. So fast forward a little bit, finding my career 20 years ago, actually next month, I jumped in and started in the financial services sector. So as a way to kind of keep me involved, they said, "Hey, Troy, why don't you take these assets and manage them?"
Yeah.
And so that's how I got my foundation in really commercial real estate first, before we ever moved into residential and then multifamily.
Yeah, that's pretty awesome. I'll get to you, Nate, in just one second. But it's like, almost all the stories are like, oh, I became an accidental landlord or I fixed up a house. But not a lot of people start out saying, hey, triple net is a cool thing. So it's nice that your family was involved in that. Nate, what about you? When was the first time you remember thinking about real estate as something that could play a role in your life?
Yeah, I thought about it pretty early on. I was in my early 20s, but it's just too bad I didn't act on it at that time. But I had read Rich Dad, Poor Dad in the cash flow quadrant when I was probably 23, 24, and it really changed my mindset, my outlook on what could be possible. And so, he doesn't talk a lot about real estate in those books, but a couple things stood out to me. One was he did mention a few times, I just thought it would be so cool to own 10 or 20 single family homes, get them paid off over the course of 15 to 30 years, and then just have that passive income, right? That's kind of the mailbox money that everyone kind of aspires to. But I just kind of sat on that info for a little bit and did a couple other things. Where it really started to kind of turn for me into real estate was probably over a decade later, when I just wasn't real satisfied with my marketing job, was looking for an out there, and met with a local real estate broker just to talk about what would it look like, to be an agent, to get into that side of the business. I thought that'd be interesting because, of course, I watched, HGTV with my wife. We watched like the flipping shows, and I'm like, I could do that.
We all think we can.
Exactly. Yeah. So that was kind of the start of thinking about getting into real estate. The first broker I talked to, who actually was a reference from Troy, he actually talked me out of it. He's like, it's really, it's a lot of work. It's a lot of money. You got your desk fees and like all this kind of stuff. And he's like, it's really hard to make a go of it. A lot of agents fail. And for a while that actually kind of talked me out of it, because I was looking to get into it part-time just to see if it would even be a good fit. And luckily, about a year or two later on LinkedIn in our alumni group, someone posted about getting into real estate part-time. And so I had breakfast with my soon-to-be managing broker, and we hit it off. And within a few months, got my license. So that was kind of my start, was just on the sales side.
Yeah, awesome. Yeah, I get that with the Rich Dad Poor Dad book too, though. It's important to get the knowledge in there. Like my kids are 23 and 21. They both have the book. I think maybe they both started it. I don't know if they finished it, but I know it's getting in there. So I think you never know when you're going to come back to use the information or when it clicks. But yeah, that's excellent. And I've always said, though, in terms of the license, I think everyone who wants to invest should really have a license, just because you have extreme access. You have access to C properties and you have access to the MLS. So you have advanced information. So over time, it's worth it, whether you're going to actually do business part-time or not. When did you guys connect? Did you know each other before you started doing business together at the company, I mean?
Yeah, we've known each other since, I guess, our mid-20s. I remember Nate getting into his real estate career. I had done some single family investing before that and had a similar journey. I think I read Rich Dad Poor Dad as well back in like 2010.
Yeah.
Used a little bit of leverage for the first time, and then found the Bigger Pockets podcast. And Nate and I just started talking about it. And I remember for me specifically, I had all this experience on the commercial side, really did not use much leverage at all, and heard about the BRRRR strategy. And that's where Nate and I started talking. We're like, wow, that's a really powerful strategy. Let's talk about it. Let's see if we can pursue that a little bit.
Yeah. But that's interesting, though, because I've been talking about BRRRR a lot lately, but because it's not working now with the rates. But it's so interesting that a lot of people did do really well and collaborate over this whole BRRRR philosophy. But I think it's important for people to know, if they're reading the BRRRR book, which is a great book, it doesn't mean it works right now. Small scale, large scale, it's just a different landscape. How have you guys transitioned just in your own personal investments and then with the company over the times? As rates change, we need to adjust our businesses. So Nate, for you personally and with the company, how has that changed the dynamic based on the way that we know BRRRR doesn't work in most markets right now?
Right. Yeah. So around that time when we started talking about real estate, it was interesting because we kind of came to the same conclusion around the same time, because I had been an agent for a couple of years at that point, and I had a property manager friend of mine text me the latest episode of the Bigger Pockets podcast, and I had never heard of it, and I had never even been exposed on the investing side, even though I had been an agent for a couple of years. And so that was around 2015. It was maybe episode 100-ish.
Yeah.
And so I started listening to it. Ran it back all the way to episode 1. So it started off like anyone should, with the education piece. So we listened to the podcast, we read books, and, just kind of had a meeting of the minds, like, how are we going to do this? What can we do to grow the business? And so at that time, there were still plenty of short sales and foreclosures and opportunities.
The good old days, man.
Yeah, opportunities like that in our market in kind of the far west suburbs of Chicago.
We were buying deals in 2010. We were buying deals for $50,000. Getting $900,000 in cash flow. I mean, forget the 1% rule. We're getting 2% on these things. Yeah, it was great. It was great.
Cycles are really important, though, because it's good that you guys were able to capitalize on that. But then there's also some people who maybe did well then, and they've been sitting there now for 10 years going, well, I'm just going to wait till it gets back to then. It's like, nah, that's not the way the cycle works. So it's important to note either way that things are going to change, and you have to adapt to it over time.
Yeah, you got to pay attention to what's going on, because there have been periods where, we go pretty hard, and then there are some periods where we kind of sit back and kind of take account of things and see where the market's moving and how do we position ourselves for the next, opportunity. So back then it was trying to do the BRRRR strategy, and we weren't perfect at it because we were kind of new, but we did what we could with our first few properties, and then pivoted again, more like, on a location basis, because Troy had moved to South Carolina at that point. Yeah. So we were picking up properties in some other states.
What led to you guys forming this group and working together eventually? Because what I've heard from a lot of people, of course, on all of these episodes that we've done, is a lot of the basis for getting there is part of that figuring out what to do with single family, or even knowing stuff about triple net early. But then eventually you realize it comes to a point where well, there's a better way to do this at scale, and you know enough to scale. When did that happen for both of you?
Well, I think there were 2 steps to where we're at now. First, really what we're talking about now is the company that Nate and I started together. We've invested together on, like we said, we started with Burr and we've moved into multifamily, but then Missional Capital Group is something completely different. We started that this past year. And really, the reason we didn't start that earlier, I've wanted to start this company for 10 years, was due to compliance restriction. I'm a financial planner.
Okay. Yeah.
So last year, really wanting to do this, almost feeling guilty that as a fiduciary, I've been investing in real estate for 10 years. My clients have not had access to that. You know what I'm saying? And it's crazy.
That's a classic conundrum with financial advisors. Now, of course, being in real estate, but I remember growing up, my dad was a real estate investor, but he gave me stocks at 16 with an advisor at Merrill Lynch and said, here, learn to invest. But I remember as I was growing up and I still had that person, he's like, oh, don't invest in real estate. I'm like, what do you mean?
Yeah.
So there is this kind of like dichotomy between what they want.
Yeah, there's no financial incentive for an advisor.
Right.
If they can't control the asset, if they can't collect a fee on it, they're not going to encourage you to go out and invest in a syndication.
Yeah.
I think that's a shame. When I meet people, Jonathan, when you hear someone who has no real estate in their retirement portfolio, what do you think?
Crazy.
And they've missed an opportunity.
Yeah.
So as a fiduciary, these are people that I've been working with for 20 years. I love them. They're like family. Yeah. Said, I have to figure out a way to create an investment opportunity for my clients.
Yeah.
So back in mid 2023, I finally kind of jumped through the compliance hoops and did what I needed to do in order for us, Nate and I, along with 3 other awesome general partners, to create Missional Capital Group.
Yeah, that solves a real problem, though, because what you're saying is something I've heard over and over. And I like I said, I experienced firsthand. I think generally all investor advisors will advise for a diversified portfolio. But as you said, when you're a financial advisor, there's no benefit to getting somebody into a real estate deal. So if they're 50% in real estate and 50% in, stocks, bonds, you're at a 50% loss for business generally.
That's right.
Yeah.
That's right. There are a few semi-solutions, different REITs, privately traded REITs, which typically haven't been great for investors. High fees, high commissions up front. So
not that much fun.
Yeah. It's not something, liquidity issues.
Yeah.
It's just not something that I wanted to pursue for clients. And having the background that I had, I don't trust anyone more than myself to manage my clients' assets.
Yeah.
So that was kind of the initial thought. And obviously, as the opportunities opened up, Nate's like my brother. We've done this forever. He's in. And, we talked to a few other guys that we really trust and admire kind of on a business level. So that's where it started.
Yeah. Just going off of that, I'll go to you, Nate. How important has just building relationships been for you guys in real estate? Of course, now you said you've known each other since your mid-20s, so that plays a big role. You bring in 3 other partners, but over the long haul, especially as you get into larger and larger projects, have you found that the relationships are really what make real estate move, not necessarily always the actual numbers on the deal?
Right. Yeah. Relationships are everything. Even if it's people you don't know really well, there's still going to be, even if you're just looking at like a single property transaction, there's probably 20 or 30 people involved in front or behind the scenes. You got title companies, attorneys, you've got inspectors, agents, transaction coordinators, all these people helping to make one thing happen, to have a buyer and seller transact. And so, yeah, relationships, that's part of it, but that you can come upon somewhat quickly. You want to vet as best you can, but long term, you need those relationships. And that's why I'm a huge advocate for in-person networking. Go to as many conferences as you can, go to as many meetups as you can.
Yeah.
Back when I was in the Chicago area, I started my own meetup just so I could kind of control, the topics, where we met, when we met, that kind of stuff. In fact, I've got one happening tonight. So those are always great opportunities because you never know who you're going to meet, who you might partner with. I think the best meetups have a very collaborative approach. And I've done multiple deals with people that I've met through networking like that. And then, like Troy said, he's had clients for, 2 decades, and he's curated those relationships. And now, some of those are investing in the deals that we're doing right now. And sometimes you just never know what relationship might lead to another one too. Like when we got into this syndication model, a year and a half ago, I mean, the first step is there's a lot of legal stuff, right? But we didn't know who to reach out to for that. But I had a great connection who I knew had been in the syndication space. He has a fund. I'm like, what syndication attorneys would you recommend? And we've been using their company ever since. So yeah, relationships make all the difference. And that's why you got to continue to curate new relationships too.
Yeah, I feel like, for all listeners, if they haven't been to meetups, they don't really understand the kind of giving aspect of it. The more you give, the more you get. And in the spirit of giving, I told you guys that I would let you plug something that we're going to drop at the end of this program. You have something special that the listeners can get if they stick around to the end. What is it?
Yeah, so we do have a book that we will send out to you. I'll let you know at the end of the episode how you're going to get that book, but it's the Hands-Off Investor by Brian Burke.
My guy. And he's been on the show. He's a legend.
The book really is a great resource for both general partners if you're looking to get into a syndication or fund space, or for limited partners who may not know how to vet an operator, a sponsor, a deal. I mean, it really goes through everything there. So it's a great resource for a lot of different people. And we'll talk later at the end of the show to let people know how to get it.
But that is in the spirit of giving, really, because I didn't know which book it was, honestly, before we said that. But the whole purpose of Brian's book and his, for you guys who run syndication model to say, hey, read this book first, you're really making sure that you're betting on yourself, because the whole premise is operator first. So you're really saying, like, we have to live up to this. If this is kind of one of the assets that we want to send to people, we want you to vet us. That's part of being a good operator, right?
Correct. Yep.
Yeah, we send that not only to prospects, but to every investor that we have in our deal for exactly that purpose. We're fortunate in the fact that none of us, our 5 general partners are not dependent on our syndications for our income.
Yeah.
And I think in the last 3 to 5 years, you saw a lot of that, right? You saw a lot of sponsors who were so dependent on, cap rate suppression to get out and a quick exit so they can go and buy another deal for their, acquisition fee. So we really do. We want our investors to make sure that they know what they're getting into. They know what we're doing as general partners. So I think it's a great gift for us to give away and try to add value to anyone who's listening, and Jonathan, your audience as well.
Yeah. And like you said, I mean, when you're an operator and you need it to go well, you're almost in like fiduciary breach in some ways, because your focus on the actual investors, your LPs, the people who put up their 50 to 100K or more, that gives it an imbalance right there, because you have to look out for your own self-interest because you need that money. And that goes, though, to Nate, as a real estate agent, that's what we call commission breath. It's like, I don't really love this house. Why are you pushing me to get it? It's like, you can always tell the difference. And I think that is a really important part, especially what we've seen over the last, couple of years, as you said, with syndication. Some was bad debt, but a lot of that was bad operators who didn't know or inexperienced taking on bad debt because they wanted to get something done.
Yeah. Bad debt's a whole different issue. And I know our company has a lot of thoughts on that, but certainly there are some operators who jumped in and just got out over their skis. And, unfortunately some investors were hurt through that process.
Yeah. I mean, how did you decide, though, that like syndications were going to be something that worked for you? Because it is a difficult thing when you start taking money. Of course, you, Troy, had good experience because you were used to handling other people's money, but it's a big thing to take on when you're going to put it into deals and saying, hey, we're going to take this pot of money and we're all going to win on this particular deal.
I think we felt confident because of the strategy that we use. We typically go in with very modest leverage. We do, between the 5 of us, have quite a bit of experience in the real estate space.
Yeah.
So for me, and maybe it's because I've been working with clients for 20 years, that was not an intimidating piece. As long as I'm putting together a great deal that's cash flow heavy, low leverage, fixed debt along the way, I'm not going to get stuck in a position where we've got bridge debt coming due in 3 years at a higher rate. That gave us a lot of confidence knowing what we were walking into. And truthfully, our timing was not totally by accident. We knew what was going on in the space. We saw all of these, unfortunate failures by other sponsors. We said, listen, this is a good opportunity for us to come in, do this the right way, focus on longer term projects. We're not projecting, 28% IRR in 2 years. You know what I'm saying? It's like we want steady, consistent cash flow and good deals in good places, good locations.
Yeah, I think the general consensus of good operators is under-promise, over-deliver. But whenever I say under-promise, sometimes people think that means like you're giving away. It's like, no, just be smart, deliver something consistent, and then try to beat that. But no, either way, you're going to deliver a really good experience.
That's right.
And also that for both of you, that takes a lot of vetting up front, though, because I think people who get sent to syndications, if they don't know, knowing the cash flow and what's going to come on different syndications is a big deal. A lot of people invest in syndications and don't understand they're not getting money for 2 years because it's a conversion project or something. Right. So these are things, you guys vet these people up front to make sure they understand what they're getting into and that it's not as liquid as maybe a single family house that you can turn around and just sell if you don't want it.
Yeah, exactly. And there's so many different fund models, fund structures, and then deal structures too. Like you said, it could be a conversion and it's going to be heavy value add and it's going to take, 18, 24 months to even finish that. And then you got to lease up from there. And then you got to hope that the market, the timing is right too with some sort of exit, whether it's a refinance or a sale at that point. And our strategy has been just to really hedge against the risks of high interest rates and to build out a sustainable cash flow. And so we've been fortunate with, the deal we purchased last summer and then the deal we're closing on this week, that they're in a market that we've already been investing in for, 7 years. We have great third-party property management in place. And these assets are, one is 10 years old, one is 6 years old. Yeah. And the builders shared the same blueprints. And so we know exactly what we're getting. We're getting 2-bed, 2-bath, 1,200 square feet. We know what the rents are over here. We know what the rents are going to be here. And so it's as risk off as possible for us. It would have been a lot different had we decided to go into a different market that we didn't know. We'd have to build out a whole new team, understand that market, and then, kind of relate that strategy to that market as well.
Yeah. So what market are these two deals in?
These are in Northwest Alabama, about an hour outside of Huntsville. Troy, maybe you can tell the story of how we found that market in the first place.
The long story short is we were very fortunate to find this market. So Nate and I really wanted, when we knew Burr was coming to an end, when we knew that strategy probably wasn't viable long term, we said, well, what's the next step for us personally as personal investors? And we found a 20 unit, and I just found it on LoopNet. And couldn't believe how bad the numbers were, like horribly bad. I was like, this can't even be possible. How can a 20 unit be generating like $30,000 a year? Yeah. So dug into it, and sure enough, there was a glitch. The property management company happened to switch software that year. So they issued 2 1099s to the owner. And when they uploaded everything to LoopNet was only reporting one of the 1099s.
Wow.
So half the income, not even half that the asset was bringing in.
Yeah.
So we jumped on that deal and didn't know the market very well. And we've been very fortunate. We knew it was a good deal on the real estate side of things, but we had no idea how this market would just blow up. It's Florence, Alabama, the Shoals area, an hour west of Huntsville, tons of growth.
Yeah. Happenstance is a big part of the kind of keeping your head in the game. And I've been talking about this a lot, that you don't always have to be buying, but the fact that you were looking or just searching on LoopNet one day and found this and decided, that doesn't even make any sense to be this bad, is just a point to, stay at it, stay looking. You don't always have to be buying, because if you weren't looking that day, somebody else could have found it, or they could have corrected it before you did. Have you guys found that important, especially now with a big, capital group like this, that you can't just take really a break? I mean, of course, there's 5 of you, so a couple of you can take a break at a time, but being on top of the market is how you vet enough deals to make sure that you can complete just one deal in a year.
Yeah, certainly when we're getting close to closing, like we are on this 71 unit complex community this week, our attention is there. However, we're always looking. I really enjoy the search process of finding a great deal. Nate, maybe you can talk about, actually, I mean, one of our main sources for deal finding has been our property manager. And that's a great strategy for anyone looking for off-market deals. We think that's a great strategy.
Yeah. I mean, most people, they rely on their agents or some other part of their network. And again, we kind of fell into this too, because I think we heard it as a tip, maybe on a podcast or at a BPCon or something like that. But, talk to your property manager. And even though we talked to him about the property, eventually we're like, oh, he already manages 500 other units, and he's been in that area for his whole life. He knows things that are going on. So we just let him know, hey, and we just remind him every quarter, hey, we're buyers. If you got something, let us know. And the last 4 properties I think that we've purchased, including this one that we're closing on, were all from him. So it's not like we even really had to dig. We still look, but because that's our market and that's our manager, we trust him and his network, and that's been a great source for us. So I would recommend, anyone, just property managers can be a great source too for deal finding.
Yeah, it's a great tip. And again, it goes to the building relationships that we were talking about before, because who's going to know better which owners are really checked out and not managing the manager better than a property manager? It's like, which of your 500 units, which owner is the least involved with you, and the property is not doing that well? That's an immediate target, because it's actually in their best interest for you guys to reach out, because they don't care. They're leaving money on the table, which means the maintenance probably isn't good, because property management can only do so much. They're there to collect the rents and make repairs, but they're not, deciding when the facade needs a change to make it more palatable to people coming in to up the rents.
Exactly. Yeah. It's been interesting to see how that's played out, because sometimes, they are just a tired landlord and they're ready to sell or make a deal. And we were able to get some seller financing on a deal we did. What was that? Maybe a year and a half, 2 years ago, Troy. Because of that, there's just some things you can do, and that goes back to relationships too. When we were doing our due diligence on that deal, that was like a 14 unit kind of, 3 properties? 4 properties, 4 parcels in a neighborhood where we already owned some other real estate. And, being there for the due diligence part of it, touring the units, meeting the seller, that really enabled us, because we were very, conscientious and kind to his tenants and to him. And when we were looking for some seller financing, he was more amenable to that, because he had met us and saw how we had treated everyone in the process.
Yeah, I think that general newer investors think seller finance is an opportunity for them to find their first investment, which is very, very extremely rare. They don't realize that the majority of seller finance deals are done by people who don't need seller finance, but it's an advantageous play for both. And it's definitely built on the relationship. Hey, you can save on cap gains. Like you said, you already know us, so doing seller finance, it's not a big deal. It's actually going to work out better for everybody. But it's advertised differently. Hey, buy real estate with no money down. That's not really realistic, although, in a nutshell, it's possible, but not real. Troy, have you seen that as well over the opportunity to get seller finance? It actually usually comes on larger deals, or sellers who own multiple properties, because they get it.
Yeah. Yeah. Obviously, yes, I've seen that trend, and there's a whole community built on that trend. And I think the concept's really, it's a great strategy. I think it's just harder to implement than most people probably expect when they're signing up or jumping into that community. Yeah. Especially on single family homes. I think that would be a little more difficult. You're right. In multifamily, there's if there's an owner who's sitting on a massive capital gain, they've owned the thing for 30, 40 years. Yeah. it's a good opportunity for them. Instead of moving their money over to a bank and getting 4% in a CD or something, why not lend on the property that you know what that property should generate in income. You've got, the collateral on a property that you already know and love. And so I think that is definitely an opportunity for larger deals, like you said, Jonathan.
Yeah, I've sold 2 commercial properties on seller finance, and then eventually they either completed the cycle, or they sold. And it just made sense. One, we did because we had 2 of the 5 units were vacant because a gym had moved out. So we weren't going to people weren't going to qualify because we didn't have income coming in there. So we just sold it to one of the tenants there. It just made sense. And I think people forget that you can get more as a seller from seller finance.
That's right.
The buyers are just going to dictate the terms a little, but you're going to get paid basically whatever you want on seller finance, within non-insane reason. And I think that those are the things that, again, aren't put out, in these classes or groups where they're building, which again, those things can work. But I think the people trying to do these things aren't experienced enough to do them, which means they're not giving a transparent experience to the seller in these, so everybody's on the same page. Right. I mean, this is what's crazy.
Yeah, I'm laughing, Jonathan, because something you said just triggered a thought and a memory. So seller financing, it's funny when you get into these markets, a lot of the owners of these complexes know each other. And what's their main goal, right?
Yeah.
They just want to sell, for $1,000 more a unit than the next guy.
I need to beat Rob. I'm just going to rub it in Rob's face. Right. I don't care. Yeah.
Exactly. So seller financing, sometimes you're right. They'll be like, well, definitely I'll do a little bit of seller financing if I could just outsell my friend down the block a little bit. And actually that's what we've seen kind of in this community a little bit. So
yeah, and I've told new investors that if you ever hear the words "hold paper," it means something, and they don't understand. They think like someone wants to do drugs or something. I'm like, no, that's the 30 years ago what people used to say when they wanted seller finance. And old school real estate investors will still say, yeah, I'm willing to hold paper. But a brand newbie who's just looking to acquire a single family, no idea what they're talking about. And that's why the large scale of it is important. It's important to know BRRRR, like we said, but right now you have to know that strategy is not going to work. Hey, it's Jonathan. I hope you're enjoying this episode with Troy and Nate. And if you're interested now or at the end in what they do at Missional Capital Group, all you have to do is go to missional.group. It's pretty simple. When you get on there, you can see the current offerings, you can connect with them, and you can go to their knowledge center. Let's get back to the guys. Nate, have you seen that your experience as an agent has helped you? Because it's a total different ballgame, commercial agent, residential agent, and how everything goes about it. But the constant upkeep of dealing with clients in all types of transactions as an agent really give you wide scale into the emotions of residential, and then the lack of emotion with commercial, which fits much better to my personality of no emotions other than for my kids.
Yeah, absolutely. Yeah, there's a couple things, a couple thoughts on that. I personally don't think I would have ever invested in real estate without being a real estate agent first. I think personally, I needed to have some sort of comfort level with just on the transaction level. And so when Troy and I bought our first property, I'd done roughly 60 transactions at that point. And so I felt comfortable because I had the knowledge, I had the MLS, I had the access, and I had those relationships. I had the attorney, I had all these things lined up. And so I felt comfortable, even though we had never done a big scale remodel or rented out a property, just with the two of us. That really helped quite a bit. And then to your point, residential versus commercial, I kind of shifted my agent business when I was in Chicago to working more with investors just because I was more interested in that. And there was less emotion. In fact, I wrote an article for Bigger Pockets a couple of years ago exactly on that topic and why there's less emotion on the commercial side, because it's more about the numbers. Now there's still going to be some emotion. Everyone wants to get the deal done. Some people might get a little riled up, but it's not like, you get a phone call as an agent from, someone on Zillow or something. And they're like, what's the color of that wallpaper in the dining room? I can't really tell, and that's all they care about. And they'll lose a deal because of that. Yeah. And so it is quite different.
Yeah, it's almost comforting, but then it's just a differential. When you're looking at numbers in commercial, I think people forget that there's a huge part of it that's due diligence. It's that you just don't move to the due diligence phase on large scale until you've reviewed the numbers, because if they're not in the ballpark, it doesn't really make sense unless you get lucky like you guys did on LoopNet. But that's a big thing. Getting reps in commercial is a little bit different than getting reps in residential. In residential, you need to see 100 homes. You need to see the dumps to see what they smell like. When you're buying multifamilies, you need to understand the numbers first to see if it's even worth your time, right? Because that time that you spend on a bad deal is time taken away from vetting something that could be a better deal.
Yeah, I couldn't agree more.
How much of that vetting goes in? I mean, how many deals are you looking through in terms, like percentage wise, until you get to a deal? Because I know it's a lot. You have to run through a lot of deals to even get to one that you're even interested in offering on, especially now.
A lot.
When it's too many to count, it's a lot.
It really is. Yeah. And it's from different sources. I mean, obviously we talked about talking to different property managers, but it's also different brokers out there that we rely on send us deals before they hit Crexy or LoopNet. And we still look on there, but we've got, I mean, in my inbox every day, I've probably got 20 realtors who are sending me deals, asking for our buy box, wanting to know what we're looking for, if we're looking. So that process just doesn't stop. And especially now, what's kind of neat about the timing right now is deals aren't moving as quickly as they were.
Yeah.
So as you see something come in, and if it catches my interest, I can mark it. Even if we're at Missional, if we're not ready to purchase something now, there's a fairly decent shot that this deal might still be available, 4 to 6 months from now.
Yeah.
So.
Yeah, and those are my favorite. I like having contact up front. When it used to be more inventory, I used to approach just on a single family flip, and I'd be interested. I'd say, yeah, you're not even close to where I pay. Just let me know if you're going to go down at some point. I'd still want to go way down, even they got to the price reduction. But then when I'd see the first price reduction, then I'd interact again and just wait them out, because I already knew the value, and I already knew that other people would come in, make an offer, then do inspections, freak out, and it would be right back on. But that goes to the more reps, and you guys can look at the numbers and say, okay, other people aren't going to like this. It's going to sit a while. It just doesn't make sense. And that's very prevalent right now, even in small scale multi up to like the 10 units and under. The numbers just make literally no sense a lot of times with the rent roll. You're like, how do you think you can charge this? There's no really gain for an investor to buy this.
Yeah, there's still a little bit of price discovery going on in both the residential and the commercial market. Yeah. And over time, like you say, people will start to have more and more realistic expectations of value, and for buyers, what to offer as well. Because in a high interest rate environment, most people are not buying cash for everything. You definitely have that contingent, but most people are having some sort of financing on it. The numbers have to work, unless you're, just looking to park money and you don't care. That's a whole different story.
Yeah. What does your guys' buy box look like now at Missional Capital? Like, what are you looking for? What's the preference area-wise and deal-wise, units-wise, something like that?
Right now, we're typically looking at deals from 50 to 100 units. We think for us, that's a space that is not, we're really not in competition with large syndicators.
Exactly.
Yeah. But it's a good space for us because it's not like you're finding a $500,000 deal there. These are fairly large deals, anywhere from $7 to $10 million. So we've found that's a good spot for us right now. If we can continue to focus on the Florence area, that's where we're going to focus. There's a lot of opportunity there. We've got a few deals earmarked that we think might be available within the next couple of years. So we're looking at those. Nate, anything else you want to add to our buy box?
Yeah, I think what's been cool about since we've gone the syndication route is the opportunities that we've had. Like I mentioned earlier, one property is 10 years old, the other one's 6. I would consider them A- properties. They're really good condition. They're newer, they're sprinklered, all that kind of stuff. Yeah. So they have a lot.
That helps with insurance a lot too, though. Sure,
which has also been a huge issue for commercial real estate the last year or so. And it's just fun, we started off buying like CE class properties, right? That's where the numbers made sense. We were happy to do it. But over time, you kind of shift a little bit, like I'd like to own something a little bit nicer, move up not only in price and value, but to something that's a little more that's something I wouldn't mind living in for sure. I mean, these properties are really quite nice. And so our buy box, I think, has skewed toward that, at least for the moment, to something that's a little bit newer for a couple of reasons. Like you mentioned, insurance, maintenance and CapEx are not as, difficult on a newer property like that.
Yeah.
And they're more enjoyable homes for our residents.
Yeah, and once you have proof of concept and you can raise and you have deals, then you can upgrade it because like, hey, we don't have to do C again. That's how we learned, and now we want to get in. Our investors are going to appreciate that more. It's a different thing. I mean, there's heavy value add, soft value add, reconditioning, remarketing sometimes, all different options, but it's always, location, 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 oldest statement in the book, if you can find that. And then I really like what you guys are doing on focusing on an area that you never would have thought you'd be in before, but clustering has always been one of my kind of tenets of real estate. The more you can get in an area, you prove that that market. So now if when you get this 71 unit, you're like, well, we've already done it on 40 units. We know the rents, like that property over there is our rental box. So we know.
Well, and to your point, here's a great example. We bought the Timbers Complex, which was a 55 unit complex community, in June. And we are already well ahead on when we have turnover, we're very careful about the way we raise rents on tenants. But when we have turnover, that's a really good opportunity to test the market.
Yeah.
And we are getting rents well above what we thought we would in the first year. So when we moved 2 miles down the street to a very similar complex, it was much easier to go back to our investors, say, hey, we've already proven this. Yeah. We're already getting this over here at the Timbers. And it was a much easier sell to get investors on board because they already love the product that they're in.
Yeah, and the 50 to 100 units is really important. I've talked to all different types of syndicators and multifamily. Some, like you said, go super big, but it's a different sellout. Your sale out is not 50 to 100. Hedge funds aren't buying that. But that's interesting because you have to still know who that buyer is. It's a different version of you guys buying that. It's someone who wants that turnkey where it's already been upgraded, depending on how long you're planning to hold it. But 50 to 100 is a double hedge because you don't need on-site management for that. So you can have a manager who's running 2-3 of those 150 units without having to house it at the same unit. Is that also part of the dynamic of keeping it in that number?
It is. We're fortunate because our property manager, especially on this new deal, actually his office is right across the street. So it's almost like we do have on-site management.
Yeah.
But the area, it's we're not talking about Chicago here. It's a metro area of around 190,000 people, I believe, somewhere around that population size. So it's big enough. It's a nice tertiary market where we can find deals, but it's small enough where our property manager can be on site, any one of our properties, within an hour, within half an hour, if we need him to be.
Mm-hmm. Yeah, and I think that goes back to the buy box too. In that spot of 20 to 100 units where there's not a lot of institutional owners, it's mostly mom and pop type. A lot of people think or say, or maybe they've had this experience, because I have heard other people on other podcasts talk about how difficult it's been to find property management for that size of building, and they've gone through multiple property managers.
Yeah.
So we've been fortunate to have a rock star property manager on our team to help us in this market and scale with him. And so for us, that's a huge win for us in how we're able to reposition these properties, because not only does he know about them and what the market will do there, but we have the trust that he'll be able to implement our business plan. Whereas, I was listening to a podcast a couple weeks ago where they had bought their first deal, like a 40 unit deal in Texas, and they went through 3 property managers in the first 18 months.
Yeah.
And, some of them were stealing from them. Some of them weren't doing the work. And, just to start out that way is pretty rough. And so we felt, since we already worked with him for many, many years, we have a lot of confidence in his ability.
Yeah, I mean, that's a huge issue with property management. I think that people don't understand when you're the first time working with a company, you're not their ideal client. They don't know how well you're going to perform in terms of managing the manager, especially if you're just, for people who buy a two family, or even if they have a single family, they're like, oh, I hired property management, it doesn't work out. You're like, well, why would it? You have a one-off in one town, you're one unit, and they manage 831 other units. You're just not important to them. They probably shouldn't have taken it. But as you grow and build that, it's like, oh, now we're really in a win-win. Hey, we're getting 71 more units. Do you have enough for that? Oh, I'll hire somebody else because we need to move up. And then you're moving up together and you're really one of their ideal clients. You're going to be in the top couple clients, which make it a perfect relationship. But important to note in the beginning, it's not that easy.
Right. Yeah. Yeah. He does answer our phone calls, but yeah, if we had just started with a duplex, yeah, who knows?
Yeah. I mean, that's all part of the learning. I wanted to go back on one thing because you had both found bigger pockets. And I remember even after, 20, 25 years in real estate, I pulled up this website, 10, 12, 13 years ago. I was like, what the hell is this? Like, there's all these people who are talking about this. I had never been to a meetup, because there was no internet when I was investing growing up. There's so many opportunities now for people to find each other. And I love what you said, Nate. You just started your own meetup. I've been running meetups since 2020, and I've just found it's a great place for people to get connected. And wow, what a boost to somebody's investing idea to just see a bunch of people in a room. They're like, oh, that guy, 6 units, he's got a 2-family house hacking. It just brings it all together. And a lot of us just, happened upon the site and was like, how did this even exist?
Yeah. I love it. It's the groups that work like that. I think the best meetup groups, typically will go around the room. Everyone gets, 30 to 60 seconds to kind of pitch, who they are, what they do, what they're looking for, and something that they can offer. Yeah. And then once you get past the meat of whether there's a presentation or there's a topic, then once everyone's just getting drinks or whatever and hanging out, like, I'm going to talk to that lady there because she's a private money lender, and I'm going to talk to that guy because he might be a great contractor for the next flip I do or something like that. So it's a really great way to meet people and then, collaborate.
Yeah, absolutely. So guys, where's the best place for people to get in touch with you? Is it at missional.group?
That is the best place, and maybe this is a good time to talk about the book.
I'm not going to miss the book.
The giveaway.
Brian would be mad somewhere, but still would have a completely monotone voice like me because that's his vibe, just like me.
Yeah, missional.group is definitely the best way to get in touch with us. If you just scroll down a little bit, I would definitely say, sign up for our newsletter. And then, in fact, that's going to be, what you're going to need to do to get this book. Sign up for our newsletter and then follow us on one of the social platforms and message us there, just letting us know that you found us on Jonathan's podcast, and we'll send you out that book. So you can go to LinkedIn, Facebook, or Instagram, look up Missional Capital Group. You'll find us, give us a follow, give us a message, and we'll send out a book.
Awesome. Before we hop off, from both of you, if you were talking to a new investor who had capital to invest now in today's market, how would you tell them to get started? Because it's a different landscape than it was, like we were saying, when you could just, hop into a flip or hop into a burr without a lot of worry. I'll go to you, Troy, first.
Someone with not a lot of capital?
No, they have capital to deploy.
They do have capital.
I mean, not $10 million, but enough capital to invest. And I would always say, when I make this example, I always say they have enough to be an accredited investor. So they have a lot of options. They can do it themselves. What would you think is an ideal option now in today's market?
Well, obviously, we have a lot of faith in the syndication model doing what we're doing.
Yeah.
I think if you don't have a lot of experience, especially in multifamily, that might be a better place to start. I'll be perfectly honest. When we started Missional, even though we had a lot of experience, we were looking at, okay, well, what's Brandon Turner doing? What systems is he using? Paul Moore, I think that's how we found our attorney. We reached out to him. Who's your syndication attorney?
Yeah.
So, there's a lot to learn. And by partnering, I even jumped in as an LP on some of Brandon's deals, but there's a lot to learn. And by joining as an LP, you can kind of walk along with your general partner and learn quite a bit. So that would probably be my best recommendation. You certainly can. I mean, Nate and I, we started our company with not much money at all, and you can do that. And it's grown, and it's been an awesome experience. But if you're looking for something that's a little more hands off, that's probably where I would start.
Yeah. What about you, Nate?
Yeah, I always like to start with the end goal in mind. So, start there and just kind of reverse engineer what you want. If you want, time freedom, which is what most people get into investing in the first place, then figure out a way to get to that. Now, sometimes that could be active and sometimes it could be passive, but up front, it's probably going to be mostly active for quite some time. So you got to kind of figure that out and then pick that niche that's going to make the most sense for you. And what I always say is, real estate's great because there's a million ways to make money. But the problem with real estate is there's a million ways to make money. So you can't get sidetracked by the shiny objects out there. Try to narrow in on that one niche that's going to make the most sense for you and get really, really good at it. Once you become an expert at that, then you can either move on or you can, shore that up with employees or help in some way, move on to your next niche in real estate. So the journey might look a little bit different, but yeah, to get started, I would, start out with getting crystal clear on that criteria and that focus, and then, educate yourself, go to meetups, stuff like that, and you'll find your way.
Yeah, awesome. Well, I appreciate it. Glad to get you both on and finally have this discussion. I really had a great time and appreciate you guys swinging by.
Before we go,
what's
this cat pickup?
Oh yeah, we almost had to delay this because I was picking up a new cat. My dog passed away a year ago. I'm like not ready for a dog, so I'm thinking like I'm going to get a cat. And then just now, while we're on this call, that got canceled because I was like, this seems sketchy. I'm not even really sure it was a real cat. It looked cute, but so now I'm just going back to what I was doing. Going to go back to the local rescues, grab one. But yeah, I felt like I was going to go get an 8-week-old kitten, and I would literally have just arrived back before this. So I would have been like freak out mode. It would have been, probably hiding under, a bed somewhere. But me as a parent of adults now, I'd be thinking the cat needs something right away. So I didn't want to be distracted.
Awesome. Thank you again for having us, Jonathan. It's been a pleasure. Thank you so much.
Thank you very much.
My pleasure. Look forward to staying in touch with you guys. All right. That was Troy Zimmerman and Nate Shields of Missional Capital Group. You can find them at missional.group. Remember to scroll down, sign up for the newsletter, follow one of them, and message them on social, and you will get Brian Burke's The Hands-Off Investor book right away. Thanks, guys, for coming on the show. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on the next episode of Zen and the Art of Real Estate Investing. And that's episode 225 with Mo Hashem. Now, he's the founder of Flat Fee Landlord. We're going to go all through his background, but what he learned over the years got him to create stress-free property management. They provide professional landlord services that transform your investment experiences, making property management stress-free, or as stress-free as it can be. We'll see you next episode with Mo.